Hello, everyone, and welcome back to our latest episode of Real Take Real Estate with the Joseph team, where we give you our real take on today's housing market and everything to do with real estate. I'm your host, Maddie Maloney, and I am joined alongside my co-hosts,
Joe Sambear
and Sam Fada.
Today, we are going to be talking about ARMs. So you may have heard in the media or seen some articles about an ARM, and we really want to just dive into what type of a loan product this is, when it's beneficial, and just everything that encompasses an ARM loan, the pros, the cons, when it's beneficial, and everything there. So I wanted to start with Sam just to give us kind of a brief overview for the general viewer. You know, when they ask what is an ARM loan, what is the typical answer that you would give?
Yeah, absolutely. So an ARM is an acronym basically for adjustable rate mortgage. And what they are is exactly what that, I mean, your rate is not fixed like your typical 30-year or 15-year fixed rate loan. It can adjust after you already obtain the loan. So there's different terms. Typically, they're all a 30-year loan. However, there's only an initial fixed rate period. So we have a 7-year ARM. Other lenders have different terms for that initial fixed period. You'll see a 3-year ARM, a 5-year, 7-year, 10-year, maybe even a 15-year, where that initial period is fixed. However, after that initial period's up, if you still have that loan, it can adjust at that time based on the index that the loan is based on. So ours is based on the SOFR index, and that's a rate set by the Fed. So it's built up of two different interest rates in adjustable rate mortgages. One is your margin, which will stay fixed. It won't change at any time during the loan. However, when that initial 3-year, 5-year, 7-year period is up, that index, wherever it's at that time, will be added to your margin, and then that will be your interest rate. And then after that period, it can change monthly, it can change every 6 months, it can change yearly, and typically it's rounded to the nearest eighth. So that's really kind of what a brief overview of an adjustable rate mortgage is.
And the SOFR is a newer index, so it's newer to the financial system. It's defined as secured overnight financing rate, which, like Sam said, it's based on Treasury securities and tied into the Federal Reserve system.
Okay, great. So really, for the public, what you should really know is just what the acronym means. It's an adjustable rate mortgage, so different than your fixed rate typical 30-year mortgage that most people have. So now, Joe, I want to go over first of all, what is the benefit of an ARM, and kind of why are we hearing about it more in a higher rate environment? Why do ARMs typically come into conversation more at this time?
Yeah, so usually it comes in more because consumers are looking for the lowest rate possible, but also because of home affordability. So that's why it comes more in the news, more discussion about it, more consideration should be given to it, because when you're in a higher interest rate environment, it may be in this case, we may think there's going to be a shorter period of time that we're going to remain in this higher rate interest environment. So maybe securing a 30-year fixed at a higher rate for 30 years, it's very likely you're going to be doing something. You're going to be refinancing or paying it off. So that's why you may consider an ARM in this situation, because you may think, well, based on what I'm hearing and reading and researching and talking to some experts, I probably would, that 7 years might cover the time period I need to get me through this higher rate environment.
And when you say that too, typically with the home affordability and the lower payment, ARMs are typically priced lower than a fixed rate loan. So that's why they're coming into play, because it does offer, could be 0.5%, could be a full percent cheaper than the 30-year fixed. And that's going to be, a cheaper payment for people to consider. And if they're only going to be, planning on being in the home, if they're, moving to college or moving for a job for a fixed period of time, maybe their job has them moving around a lot. They move every 3 to 5 years. It might make sense in that scenario because there's less risk. They know they'll be moving. They'll know there'll be different options when they do move. So it can come into play in those scenarios because it typically is priced out cheaper. So you're going to save on monthly payments, save on overall interest with that loan product.
And it has to be the right the right borrower.
Mm-hmm.
So maybe more seasoned borrower,
Sure.
maybe one more financially
sound
borrower.
So
That they have, when the adjustment occurs, they have the resources to make that adjustment, and they really need to prepare, for the worst case scenario, and they have the resources to do that. Also, if someone's relocating for a short period of time, sometimes they know, we're going to be living in this area for 3 years while we finish our degree or our fellowship or whatever it might be.
Yeah.
This would be a good product to consider for sure.
And one thing too with the ARMs, I think they can scare a lot of people if they're unfamiliar with them. But with the ARM, they have caps. So that's one thing you'll want to question too. People think, oh, it's an adjustable rate. After the 7 years, my rate's going to be 25%. It just scares the heck out of people. So that's one thing. Make sure you're asking the right questions and know exactly what that ARM product is that you might be getting into, because certain ARMs, well, all ARMs do have caps. So we'll give you the worst case scenario up front. So if your rate is X starting off, and after that initial 7 years, there is a maximum that rate can go to. So that you'll want to make sure you basically build your plan around that worst case scenario in the 7 years. Can I afford that future payment if that interest rate does end up being worst case scenario? So that's something to consider with them too.
So that's a good question on if someone is looking maybe to potentially secure an ARM versus a traditional 30-year fixed mortgage. What are those questions that they should be asking the lender? So you just went over one of making sure you know what the cap is going to be. What are some other questions where maybe they don't have an advisor, like, how we would go over everything with them, even if they don't ask, but say they were with another bank or someone, what questions should they be asking to make sure that their ARM product is right for them?
One, the most important question is there a prepayment penalty if the 30-year was to go down, or I wanted to retire this debt early, earlier than year 7? Is there a prepayment penalty?
Yeah,
that's the number one
that's
question.
always a great question.
Because you want to be able to, if rates come down on the 30 or the 15, you might want to take advantage of that. You wouldn't want to be stuck in an ARM. So we want to make sure there is no prepayment penalty. Sam mentioned the adjustments, and there's a floor. So you want to know what the floor is. That's the lowest it can go, and what the ceiling is. That's the highest it can go, max rate. So those are another 2 questions you'd want to clarify.
Yeah, definitely. And I would say with those, make sure you know that there is what the floor could be. So, rates aren't going to completely bottom out. You might not end up with an extremely low rate. There is always that risk that it is worst case scenario. So that's, I would say number one question too is what would this look like if after the initial period, how high could my payment be, and prepare for that? Definitely.
So those are some great questions that you should be asking if you are looking into an ARM. Now, if you have a loan officer or mortgage banker that's trying to push you into an ARM, just make sure to ask these questions and make sure that they have your best interest in mind and that it really works for your scenario. So Joe, who do you typically see that an ARM is beneficial for? Like, do you have some great scenarios or some specific cases that you've worked with where an ARM has been, just the perfect option for them in their specific case?
Yeah, the first one that comes to mind is someone who has the resources. Maybe they're selling a house, or they're going to sell their second home. Maybe an inheritance is coming into play, and they're already kind of planning that, I don't think I'm going to even have this thing 3 years. Well, clearly right there, that comes to my mind of, you might as well take the best rate available to you. That would be the perfect candidate for an ARM. Or I think I alluded to it earlier, if you have someone saying, I'm going to finish my education here, I have a 3-year contract for my employment, and I know I'm going back home maybe home is somewhere else. I know I'm doing that. That would be another really good candidate.
Yeah, I just had one like that where they were finishing up their degree, and we were pricing everything out, and we were able to get them 1% lower basically with the adjustable rate option. So they're able to save, a good amount of money in that first few years to where it made sense for them, and there, was very, very little risk in the future because they ultimately knew they weren't ever going to meet that adjustment period.
And it's risk versus reward.
Mm-hmm.
That's the other thing is the one thing you do have to be careful about, even if you think you're not going to be there for 3 years, is maybe the market is not as sound.
Mm-hmm.
The houses can appreciate and depreciate, so you have to be careful about that. But I would say when we counsel our customers, we want to also talk about, is it worth doing an ARM for 1/8 of an interest rate?
Mm-hmm.
Is that enough reward for that risk? And we would typically say, well, we'd want to see a little bit more reward.
Mm-hmm.
If you're going to do it for a small interest rate, that might not be, even though you might have some savings, that might not be the best option.
Exactly.
Definitely. So when you're looking into an ARM, if you want to know more about an adjustable rate mortgage and you think it might be for you, just make sure to keep your options open and have your trusted loan advisor give you all the options and scenarios that should be able to work best for your situation, so that you can see exactly what the 30-year fixed rate is, maybe the 15-year fixed rate, and the ARM, and put it all together to see what option is going to work best with your future life plan and your goals. So those are just some great points. So we went over what it is, when an ARM is going to be beneficial, some key points and questions to go over. Anything else, maybe some misconceptions that you guys have been asked about, or questions about an ARM, or maybe some scenarios where someone really wanted an ARM, but it just didn't really make sense for them?
I think, again, the greatest misconception is they believe that they're stuck in that loan for 7 years, that they can't refinance, that they can't pay it off. I would say that's the number one misconception I get.
And I would say, the number two is that word adjustable really just scares people in some senses that don't know the overall viewpoint of what exactly it is and what the benefits are of it. So just make sure you talk through it, ask the right questions, and then really build your scenario and your strategy based around that worst case scenario of what that ARM could look like after that initial period's done, to make sure you're prepared for that.
And lastly, I would say that it's typically amortized over 30 years.
Mm-hmm.
That's another question of, okay, I understand adjustable does scare
it's
people.
Not a 3-year loan or a 5-year loan.
Yeah, they don't understand the dynamics of, well, it's still amortized over 30 years. It's just the initial period. The rate's only fixed for initial period. So
it's still a 30-year loan, and that's how your payment's based on. It's just that initial period.
Okay, awesome. Well, hopefully that clears up any questions about an ARM, helps make a little bit more clear of the benefits, and just to be aware of the risk that is associated with ARMs. So again, on today's episode, we went over the adjustable rate mortgage, what it is, its benefits, and the key points to be aware of and questions to ask. So that is our episode for today. We hope you enjoyed the episode. And as always, feel free to message us on social media. Leave us a 5-star review if you enjoyed today's session. Let us know if there's a topic or a certain question that you would like us to go over. But that is it. And we hope to see you on next episode of Real Take Real Estate. Thank you so much.